Welcome to the Rise of Cryptocurrencies show. I've got a great interview for you guys today. Simon Dixon is the CEO and co-founder of online investment platform banktothefuture.com, who have invested over 170 million US in fintech companies. He's an ex-investment banker turned Bitcoiner, and he's the author of the book Bank to the Future. And he's done a lot of great things with investment with Bitfinex, BitPay, and Crack, and many more. Simon, I'm glad that you're with us today.
Thank you for having me. I know we've had a bit of trouble getting this organized, but we're here now.
Let's start with your background, because you're a born-again, I can say you're a born-again cryptopreneur. So tell us your story.
I like that one. So yeah, I mean, after studying economics up to master's level, I worked in investment banking. I did a couple of years as a market maker on the London Stock Exchange, call it manipulating mid-cap stocks on the alternative investment market. And then I worked in corporate finance doing mid-cap IPOs. In 2006, I decided that it was time to throw in the corporate towel after I spent about 3 years in corporate. I started returning to some of my economic studies because there was certain things I wasn't satisfied with, and started going really deep into the banking system. So I wrote a blog and several papers, and what was put together into a really boring, geeky book on the problem with banking. And it was really focused on banks' balance sheets and how they create money when they issue loans, and various other things about bank charter acts at the Bank of England, and things that people just are really not that interested in until the financial crisis. And then the financial crisis got the world kind of interested in our topic. And because I was writing on the topic quite a lot of the time and giving a lot of presentations, I found myself in Occupy London at one point giving a talk, and from there I met someone that told me about this thing called Bitcoin, that's kind of the rest is history. Started really digging deep into Bitcoin and how it works. I spoke at the first Bitcoin conference in the world. The next draft of the book Bank to the Future was the first book that covered Bitcoin. I've been investing in the sector ever since, and just watched in amazement as it's grown from a niche sector. With the first conference had about 40 people in the room, about 20 of them were computer scientists, and the other 20 were diehard activists, into something that has really had impact, and is starting to have impact in every single aspect of money and finance, and just watching with amazement as we're seeing the sector grow from strength to strength to strength.
Very quickly, what is a market maker?
So a market maker is someone that provides liquidity. Essentially, with mid-cap stocks, there's not much liquidity, and therefore we always provide a buy and a sell price. And in the stocks that we were dealing with low liquidity, a market maker is the person that actually makes those bids and offers which set the price, and people are essentially trading with the investment bank, and the investment bank steps in and makes sure that someone can sell their stock or buy their stock, and we try and make money out of the price movements and moving the markets in between.
Let's talk about your view of banking, since you come from that system originally. What are some of the flaws of fractional reserve banking and the narrow capitalism we currently have?
Well, fractional reserve banking is a funny subject. The reason is because actually, firstly, most people don't understand fractional reserve banking. When most people, when they come out of university, well, I mean, let's not look at university, but just the average person's understanding of banking is that a central bank creates money, and a bank is an intermediary between borrower and lenders, and they exist because somebody's pension and saving is idle, and therefore they lend out that money to people, and that's most people's understanding of money and banking. Anyone that goes a little bit further, they fall upon this thing called fractional reserve banking. Now, the funny thing about fractional reserve banking is there is no fraction, there is no reserve, and the fraction doesn't exist. But the theory was, and in economics we call it a multiplier effect, that at the base of every bank there's some kind of reserves, and they are able to multiply those reserves in order to lend more money than actually is on deposit at that bank. And then the financial regulators and the central banks and the financial system try and control how those reserves are, how much leverage there is in the system by changing the interest rates. And so when an interest rate is put up, essentially that's meant to discourage borrowing, because essentially you're sending people bankrupt so they can no longer afford their loans. And when they put interest rates down, they're trying to say we need more heat in the economy, please borrow some money. And so that encourages people to borrow money. And then later they'll send them bankrupt by putting those interests back up again. And this is the boom bust cycle. And then the banks actually create all digital money in the economy. So when you log into your online banking, if you have a positive balance, there's no cash reserve for that. There's no gold backing that. It's just simply a ledger on the bank's balance sheet. And for you to have a positive balance on your online banking, somebody else needs to have a negative balance, because that deposit cannot exist in the digital realm unless somebody else borrows it. So somebody has to take out a loan, and then that deposit can exist. So that's kind of most people's understanding. But the funny thing is through investment banking and financial engineering over time, those reserves are no longer cash. They're assets that were created as debt in the first place, and they're assets that were built into the financial system. And so there really is no reserve. And the fraction doesn't exist, because while at the retail banking level you can only leverage those deposits so much, you can change that by simply changing the nature of the product and putting it onto the investment bank, and the investment bank doesn't have such restrictions. And then you could create products that package all of those loans into something that you can sell to fund managers, and then it's no longer the deposit reserve, and there is no fraction at that point. So lots of regulations exist to try and overcome those challenges that the financial system is plagued by. And it's all because the government has essentially outsourced the ability to create digital money to the private banking sector. And therefore, we have all these challenges.
When did fractional reserve banking begin? Was it done under the gold standard or before?
So the invention of fractional reserve banking, while that is predominantly a US term that came from the Federal Reserve Act of 1913, this all came from the Dutch Central Bank and the Bank of England in Europe. The Bank of England was founded around about 1694, and over a period of about 50 to 100 years, different innovations were created over time that eventually led to fractional reserve banking as we know it. And the idea behind that fractional reserve is that originally, banks were simply a safe deposit box for people's gold, and they would receive a paper receipt in exchange for that gold. And that paper receipt is money as we know it today. But then eventually those paper receipts for gold became just simply receipts for nothing. And the system kind of evolved naturally over time through years of financial innovation until we reached a situation where the entire economy and the entire money supply is dependent upon the amount of debt that can be created from the banking system.
You're an early investor with Bitcoin. Can you talk about the Prague conference of 2011 and how it impacted your life?
Sure, yeah. So my goal at attending the Prague conference was actually to understand more about Bitcoin, meet some of the developers there, and really start learning about the ecosystem a bit more. So I was brought in as a traditional finance guy to discuss kind of the difference between Bitcoin and banking. And I still give very similar presentations today, because not a lot has changed other than Bitcoin's got adoption that it didn't have back then. And so that conference was, I think that was where I first met Max the financial journalist from RT was one of the first TV shows to cover Bitcoin. We were doing a panel, and a startup was pitching a guy called Tony Galippi from BitPay that we later went on to invest in. What else was there? It was sponsored by Mt. Gox, which was the exchange that set the Bitcoin ecosystem back by about 3 years after it crashed, and 70% of all Bitcoins were held at the exchange. And essentially Mt. Gox was recreating the banking system for Bitcoin, and taught everyone the lesson that you can own your money, and that's what Bitcoin was designed for. What else did we have at that conference? It was the price of Bitcoin crashed from $30 to $3 that week. And yeah, it was just generally really just many activists. The guy that's now associated himself, I forget how to say his surname, was there, and he's associated himself with Bitcoin Cash, the one that's trying to compete with Bitcoin at the moment for the Cash user case. He was there. It really had this big impact. So what I was discussing at the time was the difference between Bitcoin and banking, and how Bitcoin in its own economy, and at that time it was very unclear whether it would succeed or the impact it would ever have. But I pointed out three differences, and that is that when you deposit your money at a bank, the bank becomes the legal owner of your money, whereas Bitcoin gave you the ability to own your own money, which is a game-changing thing. In that sense, it's digital cash. The second thing is when you deposit your money at a bank and they become the legal owner, the bank can spend it as they wish. And so people start to realize when they start to spend their money that they don't actually own it. So if you land in another country and you try and spend your money, you soon realize that you were meant to call the bank and get permission for spending that money. And when you try and send $1 million across the financial system, you soon start to realize that you need to explain to the bank why you should be able to move that money and exactly what you're doing with it. And so you start to realize that it's essentially the banks that are spending your money and dictating the flow. And they're actually putting it into what's in line with their business model, which is the property markets. That's why property markets continually go up, because it's the lowest risk, high returning asset that the banks can use with your money, and they're spending it essentially to pop up the markets that they think are the least risk and the highest return for their business model. And the final thing is the monetary policy. So Bitcoin, if it succeeded at the time, is designed in a way whereby the money supply is fixed and the economics are designed to encourage saving, whereby the price is designed to go up over time with massive volatility in the middle because it's a fixed supply asset. But it's designed to increase your purchasing power, and that's what's known as a deflationary currency. Whereas if you hold dollars or pounds or euros, then it's what's known as an inflationary currency, because the supply increases over time. And if you just hold the same amount of dollars and you never add to your savings, then your purchasing power goes down over time because it gets inflated away. And so therefore, if you are saving in dollars or any other fiat currency, you need to work harder in order to add to that, in order to increase your wealth. Whereas with Bitcoin, it's designed the opposite way, whereby as long as the demand continues to increase over the supply increases at a smaller rate. And then eventually all Bitcoins get created, and therefore the only way for Bitcoin to go is for the price to go up as the demand increases. And so you end up with the exact opposite effect. One has money based upon debt. One has money that you can't own. One has money where other people are spending it, whereas Bitcoin allows you to own it, spend it, and the supply of is the economics of it are more like sound money, which encourages savings rather than debt.
Going forward, do you think Bitcoin still has competitive advantage over other cryptocurrencies or other altcoins that are faster, more secure, more private? What are the use cases for Bitcoin compared with those?
Well, Bitcoin has no competition for the user case of digital gold. And by digital gold, I mean a decentralized, deflationary currency that nobody controls, no government can take down, is secure enough and has enough mining power behind it, whereby it just cannot be attacked and shut down. There is no other digital currency that has the same properties in the banking system created by the banks or in the cryptocurrency sector in general. So the user case of digital gold has no competition. Bitcoin's the only one. It's the only one, what we've seen over the last 3 years in Bitcoin is attack after attack of people trying to control it, own it, and see if they can exercise influence over it. And with every other cryptocurrency, it's very easy to influence. So, with things like the second largest Ethereum, the founder of Ethereum is somebody that people know. He can influence exactly how he wants the community to go. They use alternative systems to what Bitcoin works off, which is called proof of work. They use things called proof of stake, which just means the rich get richer and the rich determine the future of the coin. Whereas Bitcoin is the only one that's not actually is not actually owned or controlled. So we saw that the Chinese government tried to shut down many Bitcoin exchanges, and Bitcoin reached record highs. The government couldn't control it. In the past, the US government tried to control it. They failed miserably. We've seen that internally within the community, the people that are providing the security, the miners, attempted to control it and change it, but they couldn't reach consensus. They couldn't get the developers or the community or anyone to agree to it. The users tried to control it and they couldn't win. They couldn't get their way. And the businesses more recently tried to control Bitcoin, where they wanted lower transaction fees. They wanted it to be faster, and they just lost, and they gave up on that goal. So the reason Bitcoin is digital gold is because it's got commodity-like properties whereby it can't be controlled no matter how many people try. Every other cryptocurrency can. It's at the whim and the mercy of its founder, or it's a small, a niche set of people, and therefore it is just nothing like digital gold. Now, saying that, if you want to take some of your savings in digital gold and then you want to spend them faster, cheaper, you can't do them more securely than with Bitcoin, because Bitcoin is the most secure network in the world in terms of the computer power behind it. Then you might be interested in taking some of your Bitcoin, converting them to another cryptocurrency that might be cheaper, but you take a huge risk with that, because those currencies are more volatile, they're more problematic, they're less secure, and they're more centralized and can be controlled, and they're at the mercy, of its founders and some of the early people that have the most number of coins there. So Bitcoin is the only decentralized one, and that's why it gets a title of digital gold. Whether people use Bitcoin as digital cash and they want to use it as digital cash, the jury's out. These other user cases where privacy coins could come along and create a more private cash. Something else could come along and create a faster cash where you take a much bigger risk in terms of holding it. And then almost all the other cryptocurrencies and investments in the sector, they are investments. They don't have the use. Most people, the number one user case of alternatives to Bitcoin is to try and accumulate more Bitcoin because they're more speculative. But when anything goes wrong, everybody flies into Bitcoin, and everybody trusts Bitcoin as that store of value. And that doesn't exist anywhere else. It's the only one.
Could you explain the risks with bank deposits?
Well, yeah, I mean, bank deposits are subject to the whims of governments, and the entire system has major systemic risk, because bank deposits are essentially debt receipts, and in terms of what they're backed by, they're simply backed by the credit risk of the banking system, and the credit risk of the banking system is backed by the credit risk of the central bank. And the credit risk of the central bank is backed by the guarantee of the government, and the government is insolvent. Every government in the world, apart from the one here in Hong Kong, and that's because that's where I live, and that's because they leveraged China, who were in debt, in order to allow them to be in that situation. So it's all about what is backing those bank deposits. Now, when systemic risks occur, and every 10 years there is a new systemic risk, the banking system creates financial engineering alongside the governments and alongside the central banks in order to try and protect the system and keep it going a little bit longer. And so where we're at right now is that, you look back in history, and every 10 years you get these events. The last one was investment banking in Iceland, and then we had the next one, which was the property market in the US. The next one would be some obscure market that no one really knows too much about, but it kind of just catches you off guard somewhere, whether that be student debt or the credit card market. They're all rehypothecations of debt, and they need to find a new financial innovation in order to try and rehypothecate that. So, your bank deposits, the way that I see it is I like stable money to buy bread and to buy ice cream and to buy chocolate and to pay rent, and to buy houses or whatever you need stable money for. And so, in order to have stable money, you do need a central bank to put inflation and deflation into the money supply in order to try and stabilize its price. And so that's very good for expenditure, but that's very bad for savings. And so that's why people are using digital Bitcoin to actually save over the long term, because of the different effects. But you're subject to, cash will be illegal in the future. One country at a time, they want to get rid of cash. In terms of any, distressed financial system, the banks will be bailing in order to protect themselves, and the governments don't have the funds to bail out in the future, and the people don't have the appetite to do that. So you've got to look at what's going to happen during the next systemic risk event when there's no appetite for bailout. You're either going to get a bail-in or you're going to get a new financial innovation designed allowing banks to go bust, and for you to actually kind of protect your deposits. And I've got some opinions about what that might look like. But, as I said, while the other important thing is that laws are being changed all around the world to make the digital money that you hold at a bank. Like, for example, in the UK, they just introduced new laws, which means that if you have more than £5,000 in your account, and the government thinks you owe them tax, then they can take the money out of your account without your permission and without due process. And then you have to try and prove that money was not due to the government. And they can look into your bank account, and the bank no longer needs to get your permission if they're doing such an investigation. And so privacy around money has completely disappeared, which has big consequences in terms of, I know many people say I may not have anything to hide, so I don't care, but everybody has something to hide, because privacy is an essential part. If you didn't have anything to hide, then please, after watching this video, please send me an email with your online banking username and password, because everybody's got something to hide, and that's why the important invention of privacy online is being stretched, and taken to the limits with cryptocurrencies at the moment, because it's such an essential piece for everybody's future, really.
What does Bank to the Future do?
Bank to the Future is designed at supporting the transition away from a financial system that's run by traditional money and traditional players. So we started Bank to the Future with a very simple philosophy, and that is that we believe the future of finance was going to look very different than the past. And so we were investing in the sector, and we created an online investment platform to allow people to co-invest if they're able to, take risks. It's a high-risk investing platform. And all of the deals are centered around companies and tokens that are changing the future of finance. So one thing we didn't know, while we believed that the entire financial system was about to be disrupted by fintech and Bitcoin and blockchain companies, we didn't know which ones are going to succeed. So our goal was to be as diversified as possible. and to support the infrastructure that makes cryptocurrencies and Bitcoin and blockchain more useful. And therefore, it has like a feedback loop where it really helps the ecosystem. It produces, in the time we've done over 100 deals, and we've now got about 3 or 4 unicorns in the portfolio, and others that are may not be unicorns yet, but they seem on their way as this sector grows. So it's essentially an online investment platform for investing in the future of finance and diversifying widely in many of the companies that are having a big impact in this sector.
Do you think that cryptocurrencies have created a mechanism whereby the earlier you get in, the better?
Sure. There's many. You could study the mechanisms and the price action and the history, and this new thing that has been popularized a lot this year called initial coin offerings and ICOs. They're designed to do just that, which is that if you invest early in technology and you see the potential in technology, and that technology actually gets adoption, and then the token that powers that technology should build some kind of network effect where more and more people want to buy that, and then as more and more people buy it and more people use it, then the token value goes up over time. The analogy I like to give is imagine if there was a way of doing launching a token or a cryptocurrency in the time when the internet was first born. When Tim Berners-Lee invented the internet, he wanted to create a decentralized network, many of the same goals as what Bitcoin and cryptocurrencies have. But in the end, because there was no token, he was nowhere near as rich as the founders of Google and Facebook and the people that were building centralized applications on top of it. But if there was a token that was available for using the internet, then Tim Berners-Lee would probably be one of the richest people around today, as well as the founders of Google and Facebook and Amazon and all these applications. So what these new tokens are doing is they're essentially creating a new business model whereby the more adoption your technology gets, rather than having to focus on selling it to a venture capital or thinking of your business model, you just focus on building the best technology one can build. And then if it's designed in the correct way, then the value of that token is meant to reflect the usage and utility of that technology you're building, which in itself is a game-changing concept, but also subject to many problems, many challenges, many scammers. And so while I could paint a rosy picture of this sector, it is very much buyer beware, and people need to be very diligent in what they're putting their hard-earned money into.
Is Bitcoin proving that decentralization can work only up to a point, but everything needs a leader to make tough decisions at the end of the day? Or is it a great case study and a great practice to see that decentralization can work all the way?
I'm not a believer that everything needs to be decentralized. I think that there are certain things where decentralization is hugely beneficial, and currency is one of those user cases. I believe that in many cases centralization is much cheaper, much more efficient, and can achieve better results and a better user experience in many cases. Excuse me. But there are certain things where censorship exists. Anything where censorship exists to a major degree, then it's worth kind of having the type of technology and expense and things that Bitcoin and blockchain can give. And I don't think the application applies to everything. I think we're getting overloaded decentralization at the moment. But hey, the jury's out. It's great to be able to have such choice and to be able to see these applications prevail. Certainly decentralization in money is a hugely important thing. And Bitcoin is the only decentralized form of money that exists today. So we now have that. The invention is here. You can't take that invention back. And I think it's we're going to see every single financial service and every single product in finance attempted to be decentralized, and then people can choose between decentralized exchanges and centralized exchanges. And I think both of them have user cases. There's time and a place for both. There's time and a place for regulated markets and non-regulated markets. And I don't believe that one shoe fits all.
Bitcoin ETFs and futures. If this does happen, won't we see too many coins cornered by one buyer or leverage, or whatever is going on with the COMEX, with the precious metals?
And it does. And one thing that people need to understand about Bitcoin is that while Bitcoin has pockets of centralization, there's way too much centralization in mining. There's a degree of centralization in development that we'd like to see improved. The one thing that's proven is that the entire network and the entire ecosystem is decentralized. So while in an ideal world, every area of the ecosystem would be decentralized to create a decentralized network, the reality is you tend to converge on pockets of centralization, like mining and development, that then lead to conflicting forces, whereby you can still have a decentralized network. Now, in terms of then the next wave is certainly going to be centralization, where financial institutions are going to start using Bitcoin as an uncorrelated asset class in order to balance their portfolios. And so one of the real unique situations about where we are today is this is the first time I can think of in financial history where the average person can get in before Wall Street. So Wall Street is going to be getting in a major way. So while we've seen, the early years were really, computer scientists and geeks, then we had certain user cases where people were using Bitcoin for as censorship-resistant money in user cases where there's big censorship, for example, the purchase of drugs or casinos, and various other things that we've seen over Bitcoin's history. What we're seeing next was a user case, utility, people using it as a hedge against bank deposits. And now we're seeing hedge funds come in quite a big way. I'm an investor in many of the exchanges, and the amount of hedge funds that are signing up for accounts with these exchanges is growing really, really fast at the moment. But Wall Street is still not in. While all of the bankers that are leaving the banking system to work for blockchain companies and startups now, we're seeing a lot of these large financial institutions have lots and lots of their staff leave the system and create their own, startups. And having lots of startups is decentralizing to a certain degree the traditional finance system as well, because there's many competing companies rather than just a few large ones that we've been used to. But what the uniqueness of the situation here today is that the regulations does not exist yet for the insurance funds or pension funds to put their money into Bitcoin yet, but they all need to. The reason being is because every asset class is completely overinflated right now, and they're all correlated. The bond market's at record highs, the stock market's at record highs, and then some of the uncorrelated, what were meant to be uncorrelated assets like gold, are just not really performing the hedge that one would thought they could have performed, but for whatever reason. Whereas Bitcoin is uncorrelated because it exists completely outside of the financial system and is so uncontrollable from the perspective of anyone trying to shut it down. And because of that, every fund manager is going to need to get some Bitcoin to balance their portfolio, so that if or when the next systemic risk event happens and all their correlated assets start, they don't yield and they don't perform, Bitcoin will be the only thing that they can use to balance their portfolio. Because and so even if fund managers don't believe in it, they still need to. Now, futures market comes along, while it doesn't really have too much impact on the underlying assets, it creates a new mechanism for pricing, a new mechanism for creating indexes, and it's really the first step in a suite of financial products that we're going to see throughout 2018 that allow fund managers and everyone else to get in. Now, when Wall Street does get in a big way, which we're going to see throughout 2018, that's a lot of volume that's going to be used and locked up. And so the challenge of Bitcoin is that there's only 21 million of these things, and that supply is not going to change at all. Probably 6 million of them have been lost. About 16 million have been mined. There's only 10 million available. There's a big, scarcity around that, and that's what's driving a lot of it right now. When Wall Street starts to come in, then there's going to be even more scarcity because they're going to suck up a lot of the Bitcoins and take them out of supply. But it still doesn't change the way that you can actually use it. It just means that the price is going to go a lot higher if this happens. And then the interesting thing after Wall Street is they're going to create their ETFs. Now, before they create the ETF, Wall Street's going to get in a big way because they know that the ETF is about driving retail adoption. That's driving, the average person into Bitcoin. And so you got the next wave, which is everyone can get in now before Wall Street. Then Wall Street's going to create a suite of products that take more Bitcoins out of the supply, that change the economics and increase the price further. And then once they've done that, they're probably going to push them all retail through an ETF and allow mom and pop to invest in Bitcoin, but with counterparty risk in a very stupid way. And when those experiments go wrong, they'll start to learn that actually this is a great marketing strategy for what Bitcoin was originally designed to be, which is that when these experiments go wrong, when the financial system has a systemic risk event and that explodes one of the Bitcoin ETFs or something like that, then everyone will realize, okay, well, it wasn't really Bitcoin, but I can now use it the way it was intended to be used, and I can get myself a hardware wallet. I can store my own money. I can spend my own money, and the sound monetary policy still exists. So I see it as a big marketing over several years. And, let's not forget in 2020, the money supply of Bitcoin goes into its next halving, and every 4 years after that. And so, it's a very interesting economic experiment that we're dealing with here.
Lastly, Simon, how does this government debt get resolved, in your opinion? All around the world, we see governments that are drowning in debts. What are the options, in your opinion?
Well, one option is that every central bank in the world right now is actually creating their own digital currencies. They're not creating anything like Bitcoin. They're not creating anything that competes with Bitcoin. Essentially, what they're doing is they are creating a new money supply that is fully digital and not backed by debt and created by the central bank. Most digital money is created by the retail bank and backed by debt. The impact of that is pretty profound because the seigniorage income. So the way governments make money is through tax revenues as one, and secondly through seigniorage income. So in the case of something like the Bank of England, when you print a £10 note, it costs about 3 cents. It costs about 3 pennies to print that note, and there's about £9.97 profit margin when the central bank sells it to the bank to put in an ATM. That £9.97 is transferred to Treasury, and it creates seigniorage income, which is a form of income for the governments that reduces the amount of tax that they need to charge in order to balance or try and balance their books. When they start printing digital currencies, what becomes quite interesting is at the same time as the banking system collapsing, they could actually recapitalize their central banks and pass the money on to Treasury in order to pay down some of this debt. And there could be a really interesting transition phase that we see in the next systemic risk event. So, rather than the governments taking the bill to bail out the banks, what the central banks could do next time around is they could launch their own digital currency. It won't look anything like Bitcoin. It won't be decentralized. It won't be censorship resistant. It will have automated tax collection. It won't be a very pretty or nice form of money, but it will be stable and backed by the government and be what many people are used to. But what they could do is they could print off that new form of money, and they could allow anyone that has a bank account at a bank that's just gone bust to download an app and essentially have their bank deposit replaced with this new form of money that was created by the central bank. Now, what this does is it takes off the government's dependency upon the retail bank, allows the bank to go bust, recapitalizes the government. At the same time, the challenge is that you're taking, the system that did have lots of small, banks in it, and putting it all in the central bank. So what I think you'll see next is the central bank is going to release technology that allows fintech companies all around the world to build on top of these currencies. And then you'll see more and more decentralization in traditional finance at the same time as recapitalizing government. So that would be my next guess at where we go next. You've got to remember all of this is simply, digital numbers in ledgers of government, central banks, and retail banks, and they will always choose financial innovation over some kind of hyperinflation or rehypothecation, which we're kind of reaching the end of its limits right now. So I believe digital currencies created by governments will be the next wave that we'll see to try and bail out the system next time.
Simon Dixon, thank you very much for doing this. Could you plug people into your website? What's the domain name, etc.?
Okay, yeah. If you're interested in following me, I'm on Twitter, Simon Dixon Twit, TWITT. Someone took Simon Dixon, so ages ago I created it, and I started to build a following, so I'm kind of stuck with Simon Dixon Twit. Banktothefuture.com is for those that want accredited investors, high net worth investors that want to invest in the future of finance. And then we also have different products for people that might not be at the high net worth status yet. But those are the best places to find me.
Thank you very much, Simon.
Thank you very much.